Walmart Inc. is up 3.5% today to $87 a share. The reason for this, they have just released their latest earnings for Q3 and the market is liking what they are seeing. We're going to be going through these numbers right now and then putting them in our automated stock valuation spreadsheet and putting these numbers in our models to see if it is a buy or a sell. But before I do that, let's just go through these numbers. So we have the 3 months ended 23 for October, and then we have 24, and we also have the 9 months ended this year, but we'll go through both. So total revenue, 60.1 billion to 69 billion. This is an increase on the net sales and on the memberships. Everything is up. On the 9 months ended as well, 474 billion up to $500 billion, or 500 billion, we'll say either way, but up about 5% on each side, so that is excellent. Net income was around about 450 million in 23. That is up to 4.5 billion in 2024. And if we look at the 9 months ended as well, 10 billion up to 14. So these are all up. Revenue is up, profit is up, excellent. Basic income per common shareholder attributed to Walmart, 6 cents in 23. That is up to 57 cents per share in 24. Also, they are buying back their shares. You can see here this has decreased 8.078 million to 8.083. So they are doing a share buyback and continuing to reward shareholders by buying back their shares, which is good to see. Next, we'll have a look at free cash flow. Now, they do this slightly differently. In here, they have the 9 months ended, not the 3 months ended. Now, the reason for this is because there's a lot of variability in free cash flow. It kind of shows more long-term performance, which is what investors like, and seasonal adjustments as well, which is definitely key for a company like Walmart. But we do have the 9 months ended number here. So this is cash operating activity minus capex 19 compared to 14. That was 4.3 billion in 2023, and now that is up to 6.222. Operating cash flow is up and capex is up a little bit as well. But also if we go to here, we get a little bit more summary here. 6.2 billion, an increase of 1.9 year to date. Also, as I said, repurchased 40 million shares year to date, or about $3 billion. So everything is looking good, and the analysts, the market is liking what they see, as it is up about 3% on the day. So we'll look at my automated stock valuation spreadsheet. We will put in the ticker first what we'll do is we'll add in the latest numbers, which we can see here. Now we'll put in the ticker WMT, and this will load all the latest company financial data, but it will also have these manual overrides on some of the values so we can have a deeper look. So let's have a look at revenue first. Is it all-time highs? Yes, it is. Steady revenue growth consistently for Walmart, 672 billion. It's basically been steadily increasing. Did flatline 15-16, but has been consistently growing no matter what. Profit is in a similar story. You can see profit's a bit more all over the place, but all-time highs, 19.68 billion. Excellent to see here. So they've managed to generate more profit from the revenue. Free cash flow, not all-time highs, but in the last few years it has been increasing massively. 20.85 billion down from 2021. And if we look at operating cash flow versus capex, operating cash flow is down slightly from 24 or the full year, but capex is up slightly. So that is slightly concerning, very, very slightly, that it is down, but obviously the general trend is still up. Shares outstanding, we've talked about the buybacks. There'll be some splits here, but you can see here the general number is trending down before it shot up massively. But if we were to look at this in a few more years, or this line would be trending in the right direction again. So let's have a look at the discounted free cash flow model. This is a way of valuing stocks, looking at their future free cash flows and discounting them to today's value. $25 a share, stating Walmart is pretty overvalued at the minute. And let's have a look at the numbers and see if we agree. So we're expecting around about 700 and 720 billion in the next few years in terms of revenue, 3.5%. Analysts are saying that we are probably a bit on the bullish side, actually. They are expecting, 675 in the current year, well, 2025, and 700. They're also expecting, next year about 11% growth. So, numbers are all over the place, but I'm pretty happy with these. Net income margins, they have small margins, but they are increasing. So what we're going to do is we're going to take an average of these 2 years here, which was 2.66%, brings it up to $28, still not that high. And the free cash flow numbers, we're just going to take an average of these ones. 2024 was a very sort of an outlier. Brings us to 140%. Now I think that is a little bit high, but you'll see here it's still $30 a share. So discounted free cash flow model doesn't particularly like the stock. Before I continue, if you're interested in my spreadsheet, please check my Patreon and like and subscribe and all that fun stuff. But let's have a look at the dividend discount model. Now that has we don't have the full year data here, so if we do look at this, yeah, dividend discount model, $25 a share. We're going to skip past this. Ben Graham, I don't think Ben Graham's going to like the stock either. This is looking at earnings per share, PE of a non-growth company, AAA bond yield and the corporate bond yield, and it's currently 4.95, very, very high. And I believe we saw that the analysts said about 11.5% over the next year. Obviously, this is the 5-year growth, but if we do 11.75%, $34 a share. Don't know why it is lighting up. It shouldn't light up because the price is 45. So Ben Graham says it's overvalued as well. But finally, we do look at the comparable company model. This is a way of valuing companies, looking at similar companies and industries which are similar sizes. We're looking at revenue growth rate, EBITDA, net income, profit margins, price to sales, price to book PEG, EV to revenue, EV to EBITDA, PE, and forward PE. So companies that immediately jump out at me, we'll look at Target, we'll look at Costco, and we'll look at Amazon as well. I mean, I think that's a good set of 3 to look at. This will load all the latest company financial data for all of these as well, and then we can have a deeper look. So Walmart is the second largest, only under Amazon. Revenue, highest revenue, 600 billion compared to these, so a lot more revenue than all of these other companies. Slowest growth rate, second highest EBITDA, net income, second most profitable, second bottom profit margins, very similar to Costco, although a little increase on them, which is actually pretty good. Price to sales, market average is around about 3, and all of these retailers are below that, quite well to be sort of expected. Price to book 8, market average is around about 5. PEG does have the second highest as price to earnings growth, Peter Lynch's formula. Really, they want to be under 1, and none of these are under 1, but Amazon is the lowest, 1.69, then Target. It is cheaper than Costco, which is 5. So now we have EV to revenue, EV to EBITDA, PE, and forward PE. And basically, if we're looking at these averages, none of them saying it's a buy. $37 a share for the implied value, looking at all these averages. Dividend discount model, that was at about $25. I think that's a bit on the lower side, but still. Ben Graham, 34. And finally, the discounted free cash flow puts about 30. So all of the models saying it is overvalued at the minute, which is quite interesting. But if we look at the stock over the last 5 years, it was trending in that sort of $40 region for quite a long time. And then at the start of 2024, up 71%. So a big growth. Probably a little bit too rich at this time. But yeah, that's why we have a look at these. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. And check my Patreon. And I'll catch you guys next time.